This might surprise you, but one of the biggest tax risks in retirement doesn't occur while both spouses are alive. It usually appears when one has passed away. This is often referred to as the widow tax trap or widow penalty, which I see quite frequently with couples who have done a great job saving but are not familiar with the dramatic change that occurs when the widowed spouse is completing their taxes individually. So, in today's video, I'm going to guide you through what this tax trap is, why it happens, and how to plan around it, especially if you're not going to be needing this money anytime in the near future. Welcome back. If I haven't met you yet, I'm Christian Klassen, and I created this channel to help you make the most out of retirement. Now, most retirees are concerned a lot more with the returns on their investments, but very few consider the tax brackets that their surviving spouse will ultimately be in. If you're married and you file jointly, you get an increased standard deduction, which in 2025 is $30,000, as well as broader tax brackets, which enable you to earn more income before facing higher rates. But after one spouse passes away, all that changes. Now you're filing as a single taxpayer, which means your tax brackets are narrower than before, and your standard deduction is cut in half. So this creates the situation of the widow tax trap coming into full effect. So what is the widow tax trap? Well, it's the hit you receive tax-wise when one spouse passes away, which results in the remaining spouse having to pay more taxes on a smaller income. And this is because of two reasons. Number one, you typically lose one of those Social Security checks, so your household income drops. And second, your tax bracket increases as well, since you're a single filer now rather than filing jointly. In addition to all this, if you have a substantial amount of pre-tax retirement accounts, such as traditional IRAs or 401ks, you still have to take required minimum distributions, regardless of whether your situation has changed or not. It's a strange predicament where one's income usually goes down, but your tax rates go up, which can deplete the surviving spouse's retirement much faster than most retirees realize. So let me show you a simple example of how the widow tax trap works. We have Nicole and Gabe here. Both of them are 62 years old, and Gabe just retired from being a full-time farmer. They have $500,000 in a brokerage account, $900,000 in traditional IRAs, and they are still earning $100,000 a year by renting out their farmland. On top of all that, they are collecting two Social Security checks totaling $50,000 in annual benefits. They've invested wisely, and at this point, they're not even drawing on their IRAs yet. Between Social Security and farm income, they are just letting their accounts build up. And after all tax credits and standard deductions being implemented, their tax bill was roughly $10,700 as a married couple. But let's fast forward 11 years into the future, and Gabe has passed away at 73, just before he could have taken his very first required minimum distribution. Well, now Nicole is all by herself at the moment, but she still has this farm income coming in, but is now also forced to be taking roughly $33,000 a year in RMDs from the IRA, and she's now filing taxes as a single person. So what's her new tax bill look like now? Well, we'll skip the full math for time's sake, but it's roughly $25,100. Now, technically, her income is slightly higher because she's forced to take this $33,000 RMD, but it's not money she necessarily needs, but it's fully taxable to her. So even with one less Social Security check, her tax bill jumps from around a little over $10,000 when she was married to over $25,000 just because she's filing as a single person. She has the same accounts, but a lot less control, which leads to way more in taxes. This is a clear, simple example of the widow tax trap and how it blindsides the surviving spouse. And that's not the only thing working against Nicole in this example here. There's usually a spike in Medicare premiums as well when the married couple loses one of their spouses. When they filed together, Gabe and Nicole each paid about $185 a month for Medicare Part B and $46 a month for Part D premiums, which is $462 a month, or approximately $5,544 a year in premiums, as a married couple. But now that Nicole is filing as a single individual, her income pushes her into the next IRMA bracket. So her new premium is $259 a month for Part B and roughly $60 a month for Part D. That's $319 just for herself, or roughly $3,828 a year. This is nearly as much as they've been paying when they were a couple. So let's look at this side by side. Nicole is paying nearly $15,000 more in taxes. She loses a Social Security check, and her Medicare premiums are nearly the same as when she and Gabe were living. This is the widow tax trap in full effect. Now, before I show you how to avoid this tax trap, here's one thing you can do right now. Take our free How Much to Retire quiz. It will let you see whether you're on the right track to retire. And if you want, we can discuss if threats like this will affect you down the line. It's free and linked in the description below. So how do we escape the widow penalty? Well, it's a matter of being proactive before you take Social Security or RMDs kick in, as well as before you or your spouse passes away. When both spouses are alive and filing jointly, again, this allows you far greater flexibility to recognize income in lower and more extended tax brackets. Now, if you don't anticipate using your IRA money in the near future, you may want to consider starting to move your money from your IRA to Roth accounts gradually. And again, this is what's called a Roth conversion. And it's one of the smartest ways to cut down future tax bills, not just for you, but for your surviving spouse as well. By doing this in your 50s, 60s, and maybe even early 70s, you'll lower your RMDs, potentially prevent Medicare surcharges, and could save your spouse from being pushed into a higher tax bracket down the road. This is a strategy Gabe and Nicole never used, and Nicole unfortunately paid the price. So if you're married and you have a large set of pre-tax monies just sitting there and you don't plan on spending it down anytime soon, this might be your chance to avoid this tax trap. Don't wait until you or your spouse passes away to find out you might be giving more money to the IRS. Talk to a professional because, again, everyone's situation is different. But if you're interested in finding out when a Roth conversion works best, I've created a separate video covering the timing and brackets to consider when implementing a conversion. If this video was helpful, please like and subscribe. Thanks for watching, and I'll see you in the next video.